Let me begin by saying that this monetary policy statement that we are presenting this afternoon is a product of wide consultations. We interacted with the outgoing governor. In fact, we started talking about this monetary policy statement as late as last year. As the deputy governor said, we apologize for the delay in releasing the monetary policy statement, but it was because we wanted to fine-tune it and make sure that all the CPs are in place. Thank you, Governor, for the hard work that you put into coming up with this monetary policy statement. We also consulted with the bankers, CZI, Chamber of Mines, civic society, and also with some consultants that we got from international organizations like the IMF and the World Bank. And so the end product of all these consultations is this monetary policy statement which we are presenting today. This recalibrated monetary policy statement aims to address the current state of affairs in as far as price and exchange rate stability in the economy is concerned. It is informed by two pillars, namely restoration of price and exchange rate stability and also remonetizing the local currency so that it serves its purpose as a medium of exchange and a store of value. As you know, one of the key functions of the central bank is price and exchange rate stability and also inflation management. Before I go into the actual monetary policy statement itself, I just want to touch briefly on developments on the global market. I think you are all aware that as a result of the geopolitics, we are seeing sluggish growth in the world, and for 2023, world growth was estimated at 3.1% and remaining the same in 2024. Going closer to home, yes, our economy has been characterized by high inflation, and this is the reason why we are here today, to try and see how we can address this scourge, which has been upon us for quite a while. However, despite the high inflationary environment, I'm pleased to say that our economy grew by 3.5% grew by 5.5% in 2023 and is projected to grow at 3.5% in 2024. But that is before we factor in the impact of this El Nino-induced drought. And if you do factor it in, it's been said that we might end up with 0% growth with no policy intervention. But if we do have some policy interventions, we could achieve a better figure than that. On the external front, we continue to record the current account surplus, currently standing at 125.6 million for 2023. Now, in coming up with this monetary policy statement, we first of all did a diagnostic to say, what is it that we are trying to address? And we came up with 5 key issues that need to be addressed. First of all, there is the issue of currency and exchange rate stability. We have witnessed exchange rate instability, currency instability in this market, and this has been driven by mainly a high demand for foreign currency as a store of value. What used to happen was that, and what is happening even until today, is that if you get hold of a Zimbabwe dollar, you would want to quickly change it into a foreign currency, and more importantly, into US dollars, so that you maintain the value of your money. There's also been reduced confidence due to continued currency instability and volatility, and the widening margin between the interbank rate and the parallel market rate. There's also been reduced use of the local currency for domestic transactions. We've seen most outlets now wanting to quote prices in US dollars and not accepting the local currency. And there's also been lack of certainty and predictability when it comes to the exchange rate. Each morning, someone will just think up an exchange rate of their choice, and that is the rate that applies. So, in view of those factors that I've mentioned above, this policy is going to look at implementing a market-determined exchange rate determination system. And I'll talk about that more later when I give you the measures that we are going to implement. The second issue was on financial sector stability. Fortunately, this is not an issue at all. Our financial sector is very sound and stable. We have not seen any troubled banks. And as they say, if it's not broken, don't fix it. So there is nothing much that we are going to do. We just continue on the good work that the outgoing governor has done in maintaining discipline within the banking sector. Third issue, money supply growth. I've said in a previous meeting that if printing money could make nations prosperous, then there would be no nation which is a third world nation. We've learned from past experience that it does not help to print money. Certainly not under my watch. It's not going to happen. The next problem is foreign exchange mobilization and reserve accumulation. For a central bank to be able to defend its currency, it has to have reserve. And the governor has been doing a lot over the past year, quietly building up reserves. And I think, again, we'll talk about that later. And those of you who were here yesterday would have witnessed the result of some of the work that he's doing and has been doing. And the fifth issue has to do with the promoting of local demand for the local currency. Currently, we are being told that the economy is trading 80 to 85% in US dollars, 15 to 20% in local currency. Also, we have seen that there is a major outcry on the part of the citizens when it comes to the problem of change. If you go to a shop to buy anything, you give them $1, they give you change in the form of sweets, chocolates, which you don't need. And clearly we need to address the issue of currency divisibility. There have also been issues to do with lower denomination notes, people not accepting certain denominations of the local currency, sold notes, the list goes on. So to that extent, this policy seeks to come up with measures to deal with demand for the local currency. Now, turning to the new monetary policy measures that we want to introduce. First of all, we said, what are the objectives of this monetary policy statement? What is it that we are trying to achieve? 4 things. Number 1, we want a solid and stable national currency for this country. It hasn't happened for many years, and it's time we had that in place. We want a stable and sustainable exchange rate. We want robust policy credibility and restoration of market confidence. It is my wish that after speaking today, subsequent monetary policy statements will be just to say we are walking the talk. What we said we were going to do is what we are going to continue doing. We want a stable, a sustainable macroeconomy as envisioned in Vision 2030 and also in NDS 1. So with those 4 pillars in mind, we would want to implement the monetary policy statement in a sequential manner. Some of the things have already started happening. You just have not been told about it. First of all, determination of a market-determined exchange rate, efficient and optimal money supply management, introduction of a new structured currency, anchoring of the currency on reserves, mainly gold and foreign currency balances, and of course other measures that I'm also going to cover later on. Let's start with the adoption of market-determined exchange rate system. You would have noticed that from January, the central bank has allowed the exchange rate to float freely and to be determined by market forces. And we've been watching, because that is what you have asked for in the past, and we say, there you have it, the rate is floating. And the rate has been moving, and I'm happy to say the gap between the interbank rate and the parallel market rate has reduced significantly because of that policy stance that we adopted. So this is something that has already been implemented and that will continue 100 million US dollars in nostro balances. This is foreign exchange that we already hold. We also have 2,522 kilograms of gold worth 185 million, of which 1 ton of that gold is held offshore and the balance is onshore. Those of you who were here yesterday, you would have seen that out of the need for transparency and also for me to confirm to His Excellency that I have taken over what Dr. Mangunja left in the central bank. We opened the vaults of the central bank and you were able to see the gold that we are holding. I saw that on social media, some of you were saying, oh, you only got 2.5 tons of gold, you were converting it and coming up with a number and converting it to import cover. And then I say to myself, are these people real economic analysts? Don't they know that Zimbabwe is 80 to 85% dollarized? Therefore, we already have 85% of the money circulating in this country as foreign exchange before we even factor what is going to be converted to ZiG. As it stands currently, our entire local currency component of reserve money, which is what we reserve money in Zim dollars, as it stands, is at 2.6 trillion Zimbabwe dollars. If you convert that at today's closing price, it will give you a closing interbank exchange rate. It will give you almost 80 million US dollars. Now, let's do the maths. I told you that I've got 100 million cash in nostro balances, and I've got 185 million worth of gold, total 285 million. This entire market, the Zim dollars that are circulating, are worth 80 million. I can buy the entire stock of Zimbabwe dollars, all of it, without stressing the central bank, because I got more than 3 times cover. So, as I said to the bankers early this morning, if you want to dare me, if you want to bet against the dollar, it's game on. Because I will buy all your currency. And then, when I talk about the other measures that are coming and when you're desperate for that ZiG, I'll sell it to you at my price. Also, just for noting, last year the central bank was selling gold coins because some of you were saying, oh, where is all that gold? It's in your pockets. We gave you gold coins and you were paying for those in Zim dollars. And that's almost a ton of gold that we sold to you. But some of you were saying there's some missing gold somewhere. My brother, Dr. John, is a Christian. He doesn't take people's money. Exchange rate management system. So the starting exchange rate, as I said, will be determined by the prevailing closing interbank rate. And I've just been given the numbers today so that those of you who are good at maths can do their maths. The rate, the interbank rate today closed at 33,903.9916. And the gold PM fix, as for yesterday, was $2,293.50 per ounce. That gives you a conversion factor of 2,500 and a starting exchange rate for the ZiG to USD of 13.5616. As you can see, we are doing everything transparently. Starting exchange rate, 13.5616. That's the rate that you will be opening on Monday morning. Subsequent to this, the intervening exchange rate will be market determined, but mostly influenced by the price of gold and also the exchange rates for the other currencies that comprise the basket, as well as inflation differentials between us and the nations of the currencies that we'll be using, and the way it's obviously to determine the exchange rate will depend on, in the basket, if there's more gold than everything else, then the exchange rate will be more influenced than gold, other than by any other thing. Foreign exchange liquidity management. The bank will use 50% of the foreign currency proceeds from surrender requirements for strategic interventions in the foreign exchange market. What I'm saying is that when we get money being surrendered under the 25% arrangement, we use half of that money to go into the market. So, over and above the reserves that the central bank has, we also have an additional amount that we'll be getting as we purchase foreign currency for surrender and putting it back into the market to ensure that the market foreign exchange liquidity situation is always liquid. The remaining currency, balance of the currency after that 50% will be used to satisfy government's foreign exchange requirements and obligations, and also will be used to increase the reserves of the central bank. I'm starting with total reserves of 285 million. Dr. Mangunja said to me, after 2 years, he wants to see all those vaults full of gold. And it's achievable. Foreign exchange, foreign currency retention thresholds remain standardized at 75% across the board, except for small-scale gold producers. So what we are saying is that unless you are a small-scale gold producer, everyone, when you receive your foreign exchange export receipts, you must surrender 25%. I am a stickler to rules. This country is not animal farm. There are no people who are more equal than others. If it's 25%, it's 25% for everyone. And I am not going to entertain anyone coming to my office and saying, but I am so and so, I need to retain 100%. It ain't gonna happen under my watch. So if there are any exporters here beyond, I will not entertain those requests. We need foreign exchange to oil this economy, and it can only come from exports. And if you are going to say you are going to keep all your exports to yourself, how else is the nation going to get forex? Interest rate policy. The bank has recalibrated the bank policy rate from 130% per annum to 20% per annum, consistent with the new monetary policy framework. The overnight accommodation interest rate has been set at 5% above the bank policy rate, and the bank deposit facility interest rate at 7.5% below the bank policy rate, thus giving the starting interest rate corridor of between 11% to 25%. The bank policy rate and the corresponding interest rate corridor will be reviewed by the Monetary Policy Committee from time to time in line with inflation developments. Banks have been accused in the past of not paying interest on deposits. I know I stand guilty as charged. I used to be one of them. I am no longer. So, going forward, the minimum savings and time deposit interest rates on ZIG are set at 9% and 7.5% below the deposit facility rate of 12.5%, meaning that 12.5% minus 9% is your minimum savings rate, and 12.5% minus 7.5% is your minimum rate for time deposits. Minimum interest rates on FCA deposits remain unchanged at 1% and 2.5% for savings and time deposits, respectively. Open market operations. Going forward, open market operations will be carried out to ensure that at any one time, reserve money will be fully backed by a corresponding composite basket of reserves comprising precious minerals, mainly gold, and foreign currency balances. In other words, we are never going to have a situation where if we have got $1 in reserves, we have got $1.10 in currency circulating. No. We will have $1 or less in currency in circulation. All non-current interest bearing non-negotiable certificates of deposits, NNCDs on ZIG, in ZIG, beyond the optimal liquidity level and above the encumbered, and those encumbered by foreign exchange currency structures will be converted into tenures of 1 year and above. Statutory reserve requirements. The statutory reserve requirements for demand deposits in ZIG and savings and time deposits in ZIG remain standardized at 15% and 5% respectively. However, in order to continue to foster continued financial sector stability in the face of increased lending in foreign currency, measures will be put in place to enhance foreign exchange liquidity, moderate foreign currency exposures, and mitigate against payment gridlocks in the banking sector. In this regard, the bank is increasing the statutory reserve ratio for foreign currency demand deposits from 15% to 20% with effect from 8 April 2024. What I mean by that is that when banks lend money in Forex from local Forex deposits, there is an element of printing money, and we do not want to create virtual dollars in this market, as has happened before in 2017. Hence, we are introducing this measure to try and curtail lending using local foreign currency deposits in this market. We have no problem if a bank secures a line of credit, they can lend 100% of it. The bank is, the statutory reserve requirements for foreign currency time and savings deposits shall, however, remain at the current level of 5%. All treasury bills previously denominated in Zimbabwe dollars will be converted to ZIG and the interest rate adjusted accordingly. As I mentioned earlier on, there's been an outcry as far as bank charges are concerned. Again, I used to be in the commercial banking sector and I stand guilty as charged, but we cannot continue to have a situation where a tobacco farmer from Chendambuya sells their tobacco, uses the money, and maybe leaves $100 in the account, and by the time they come back next season, the money is now minus 100. What happened to the 100? So, with immediate effect, banks will not charge monthly bank maintenance or service charges for individual bank accounts with a conservative balance, daily balance of $100 and below, or its equivalent in ZIG for a period of up to 30 days. At least if you leave your $100 in your account end of season, you should be able to find it in your account beginning of next season. Other supporting measures and obligations. I did talk earlier that one of the things we wanted to address was promoting the increased demand for local currency. In accordance with Statutory Instrument 218 of 2023, the use of the multi-currency in the economy for the settlement of any transactions was extended to 31 December 2030, and that is standing. It's a statutory instrument. Accordingly, measures will be put in place to gradually promote the increased use of the new structured currency as we move towards 2030. In order to foster demand for the local currency, government will make it mandatory for companies to settle at least 50% of their tax obligations on quarterly payment dates, QPDs, in ZIG. This is something that we have already discussed and agreed with the ministry, and they will be issuing a statutory instrument in that regard. Also, the bank, the Reserve Bank, will continue with this strict liquidity management in order to mitigate against shocks that cause spikes in the exchange rate. Auction allotment obligations. Following the introduction of a refined interbank market, all outstanding auction allotments will be converted into ZIG and issued out as NNCDs for a period of 24 months at an interest rate of 7.5%. This process will allow beneficiaries to maintain the value of their proceeds under the new framework. By the way, I may not have made it very clear, the auction is dead. We are not going to have the foreign exchange auction anymore. The last auction was held last year, and that is the last auction. Outstanding payments for auction surrender obligations, or outstanding payments for foreign exchange purchased by Treasury under the 25% surrender requirement will be converted to a ZIG-denominated instrument with a tenor of 1 year at an interest rate of 7.5% per annum. Gold coins and gold-backed digital tokens. Gold coins and gold-backed digital tokens shall continue to be used as investment instruments and to manage liquidity in the economy with a view to stabilizing the currency and the exchange rate. As already indicated, the gold-backed digital token is no longer called ZIG, but is now going to be called GBDT. By 8 April 2024, which is on Monday, all mobile network operators who are essential to the National Financial Inclusion Strategy will also be expected to ensure that their customers can effortlessly transition from Zimbabwe dollar wallets to ZIG wallets. Domestic pricing of goods and services. Once the local currency is denominated in ZIG, all domestic traders are expected to consistently modify their pricing systems in line with the currency reforms. With immediate effect, prices for goods and services shall be converted using the conversion rate that I mentioned earlier on, and thereafter quoted in ZIG for the transacting public's convenience. Within 7 days from today, all entities other than banks and MNOs are expected to have completed the configuration of their systems to conduct business in ZIG. Ladies and gentlemen, if we implement these measures, we would expect them to have an impact on inflation, which we are estimating to end the year at between 2 and 5% annually. So, what are the takeaways from this monetary policy statement? We have introduced a new monetary policy framework that will enable stability, simplicity, certainty, and predictability. And I hope you assist us in making this currency work. I thank you.